Hello, good morning. Welcome to Canadian Allocator Panel. My name is Eric Müller. I'm Head of Investment Strategy and co-chair of the Asset Allocation Group for Mondoux & Co. Mondoux is a New York-based asset manager specialist in global credit globally and invest in both public and private markets. I am thrilled to be the moderator of this terrific Canadian Allocator Panel today. I would like to thank iConnections for having lined up such a group of panelists, all senior investors in very large and eminent institutions, to discuss what makes the Canadian market so special, so well performing, but also to share their experience with external managers. This is a virtual format and we can't meet in person, unfortunately, but I see one great advantage to that is that I don't have to remind the audience to switch off the phones during the conversation with the panelists. Now, to start with, I would like maybe to ask each of you to quickly introduce yourself. You're certainly very known to the audience, but quickly introduce yourself in a few words and tell us what institution you are in, what you're doing in the institution, and also what type of asset allocator you are. Maybe, Josee, you can start.
Sure, thank you, Eric. Josee Mondoux, and I am the Chief Investment Officer at the Canadian Medical Protective Association. Our group, unlike my colleagues, is a bit of a smaller plan. So we're roughly $6.5 billion Canadian, and we're also not a pension plan. So we are a mutual defense organization where in Canada, practically all physicians get a membership through us, and we have a reserve to pay damages if patients are harmed from negligent care. So my team is responsible to manage the reserve. We have roughly a little over half the assets in alternative type assets and the rest in conventional assets, and we divide our group amongst private, public, and the middle office. But we've also adopted more of a total portfolio approach to break down the silos and really work as one team in allocating the risk to the different areas.
Thank you, Josee. Amy?
Thank you, Eric, and great to be here with you, Josee and Mario. My name is Amy Flikerski, and I'm a senior member of the external portfolio management team at Canada Pension Plan Investment Board. Within external portfolio management, we allocate directly into public market fund managers. My specific area of focus is fundamental equity strategies globally, and I'm participating from London, UK, where I'm based.
Excellent. Thank you very much, Amy. Mario.
All right. Well, first of all, thank you very much for the organization to invite us and to share our experience. Always a pleasure to come, especially with my esteemed panelists here. CDPQ, I work at CDPQ, pension plan based in Montreal, $365 billion in assets. My role at CDPQ is to run the investment teams that is in charge of allocating money to external funds. We essentially, and we'll might discuss about this a little later, but we are in charge of all the investments across all asset classes. So we're not specifically looking at one specific area, but through liquid and illiquid markets. So our assets range over $50 billion invested externally with more than 100 different GPs. And I'll explain later as to the why we invest in funds in the context of a Canadian plan. I'm also chairman of the SBAI, which is a neutral standard setting body for the alternative investment industry. So that's who I am.
Thank you very much, Mario. Thank you very much. Let's start this panel now. The Economist magazine refers to Canadian pension plans as the maple revolutionaries. And the word revolution here is certainly to be understood as a source of change and innovation. So I would like to explore with you how innovation serves the Canadian model. Maybe a first angle to start with could be global diversification away from the domestic Canadian market, maybe because of limited size of the limited depth of the market, and then the search for global diversification. Amy, can you explain to us how the Canadian pension plan has incorporated this desire for global diversification away from Canadian markets?
Sure, happy to do that. It's a great question, Eric. I suppose we all have similarities in terms of the way we may approach or think about things, but as Josee mentioned, there are kind of ultimately some fundamental differences. So a few to highlight for the Canada Pension Plan Investment Board is, I guess our unique governance model is important to us. It allows us to be arm's length from the government and to focus just purely on investments with no interference. And our mandate is to generate returns without undue risk of loss. It's a pure investment only mandate. And that approach has led us to diversify globally, as you mentioned, outside of Canada. Starting in 2008, we established a Hong Kong office, which has over 200 people today. And then shortly after that, we also started our London presence in the UK, which also is about similarly sized. So today we have 9 global offices, and the significance of that is to have investment professionals and increasingly core service professionals on the ground who can provide expertise and to be in the flow of local networks, which is critical in terms of deal-driven type of investment strategies. So just to give you a flavor, we're in Brazil, in Sao Paulo, we're in Mumbai, Sydney, as well as several other regions, just to give you a bit of flavor, some of the key markets that we invest in.
Yeah, but Amy, this global presence, so basically you have boots on the ground in a lot of places, but is that to serve internal program, or is it also with external managers, or is it only with external managers? I mean, what is the benefit of having boots on the ground?
So maybe just to step back a little bit, CPP does a lot of direct investing. I'd say majority of our 475 billion Canadian is in direct investments, by which I mean internal teams that pursue areas like real estate, infrastructure, private equity. We also have internal public markets teams. There are 2 areas that allocate externally. Every group invests globally, but I think the boots on the ground is particularly of importance for those who are sourcing deals or assets. Being in the local flow of dialogue is of critical importance, and also having local language speakers is also vitally important. So it's I'd say the international offices have a mix of both direct and people like myself who invest in funds, but particularly in regions like Mumbai or Sao Paulo, it's important. China, it's very important to have the kind of local native speakers who are there, who are deeply intertwined in those markets. Thank
you, Amy. Josee, I understand you introduced alternative investment into the asset allocation of CMPA, and in particular investment into private markets. Can you tell us more about how your ALM framework integrated private markets and how it has evolved over time in terms of geography, type of products, and also external partnerships?
Sure. Private assets began for us in 1999. So we've had, our first, toe in the water with 5% allocation over 20 years ago. And then that grew 10, 15, 20, 25. And now we're aiming for 40% as of last year. That's been the new allocation. We are an organization, as I mentioned, a little bit different in that our main objectives, like many of our plans, is to achieve a particular absolute return target. But our other objective is to do so in a risk-adjusted manner that is better or more efficient. And so to the extreme, I mean, our bonuses are even paid on Sharpe ratios. So variability of return for our organization is a critical objective to reach. And private assets are perfect for that, because even though they may have just as many risks, if not more, than the public market equivalents, they are structurally built to reduce volatility because they do get priced every 3 months with a lag, and it tends to smooth that performance, which is useful in our negotiations with stakeholders. And so for that reason, it plays a dual role. It has an expected return that is above that of many of the public peers, and it also brings in a reduction in that variability of the performance. And so we're building it up. We also have a low need on liquidity needs. We've modeled that we could have a 70% allocation to privates, even in a drawdown, and still be sufficient on a liquidity side. So right now, aiming to get to 40, it does take some time to get there. We're active on the co-investments to try to get that target going. We have private equity, private debt, and private real assets, and are really agnostic to the jurisdiction that we invest in. It's purely about opportunity. Again, you mentioned from a Canadian side, we really don't have that bias. The Canadian economy is a very small proportion of the world, and so we don't allocate to Canada per se. That being said, I know that on the private equity side, we probably have a third of our book in emerging markets, and just following where we think whether it's a geography that has a tailwind, or we look at every year we do a research where we look at where the tailwinds might be. Are there themes out there that we think, because with privates, you're not investing tactically, you're investing in to hopefully harvest something 10 years down the road. So you want to have an idea as to where demographics are going, where's digitization going, are there plays on scarcity of capital that you can enter now that would play out over time. And so that's kind of the approach we like to take with a long-term view, as we're 120 years old, and so we're a very long-term investor, and we can have that kind of outlook.
Thank you very much, Josee. Thank you. Mario, you have been instrumental in the Caisse de dépôt shift to alternative investment, including infrastructure, real estate, private markets, but also hedge funds. Can you tell us more about how Caisse de dépôt uses hedge funds, your objective there, and your selection process?
Yes. Well, the hedge fund allocation over the last 20 plus years or so we've been doing it has changed quite a bit in terms of how we use hedge funds, from a fully capitalized portfolio of strategies, so like a fund of fund, internal fund of fund that we had, to moving to a non-capitalized or overlaid on top of CDPQ's total assets. And now moving more into more transparency, I would say strategies that are sitting across the various asset classes, but really trying to bring, for example, long-short equity on top of the long-only equity portfolio as a source of alpha or active management. Doing the same thing with credit, fixed income, or macro when we think about asset allocation. So it's really for us a source of alpha that's non-correlated with the traditional asset class that we juxtapose on top of the long-only asset classes that we have. Now, so why do we invest in funds, in hedge fund nowadays? I would say a lot of it is, obviously it's risk-adjusted return, clearly, and clearly I would say we've really shied away from the strategies that carry incremental beta, I would say. So it's more market neutral, macro, trend following, some quant investing as well. So we're doing a lot of that. So that's really important. The other thing also we're trying to bring is how can they help us, getting some insights in various areas. For example, in macro, how can they help us better strategize about currencies, about asset allocations and things like that? Or it could also be risk management. It could be cybersecurity. It could be all kinds of things that help us in terms of being better at managing other areas of CDPQ. So I would say that the common line, the common thread here with external funds at CDPQ has been really to, above and beyond the risk-adjusted return, what can they provide to the internal teams to be better investors?
That would be my other question: is how do you make the link between the internal team and the external managers?
Yeah, so we do as we try to find these managers that can fill whether it's a knowledge gap or a white space. So we do a lot of work. We have to really understand well the sources of alpha that are generated from our internal managers. So that's one part. But at the same time, also understanding, what are the investment beliefs, philosophy, strategies that are used by our managers, and try to bring something that's more complementary. So we do a lot of that work when we search and select managers. And obviously what we do also is we bring a few internal managers towards the end of a search, just to get their input on how they view this potential partner sitting around the same table, helping us in managing, different areas of CDPQ. So it's a combined effort. I mean, we lead the pre and the post investment effort. Obviously, we do all of the quantitative, qualitative assessment of the fund manager, and that portion has evolved quite a bit in the last 20 years as to how do you evaluate skill and talent. Actually, this is one of the reasons we use more and more transparency to make sure that we have a good sense of the alpha that's generated by our manager, and this obviously has a direct link in terms of how do we pay them. So paying dollars for good alpha or skills.
Yeah, we'll come to that question a bit later, actually, on the alignment of interest and fees level. Josee, just a question: do you use hedge fund in your asset allocation?
We do. We have roughly 15 to 20% allocated to hedge funds. It's not part of our asset allocation, so it's purely done through leverage. Similar to Mario, we used to tag that, make it a very low beta, kind of low octane type of portfolio, and port it on top of other betas. We've now changed that a little bit as of a year ago, where instead because we manage more the total portfolio basis, we figure the leverage is really just everywhere. And so we don't need to maintain such a tight aspect on the market neutrality. So we could incorporate in our hedge fund allocation things that are long biased if we thought that that had value. And because we manage in a risk framework, it just means you have to reduce risk elsewhere. If you're going to load up on betas or risk in your absolute return portfolio, then something else has to come out elsewhere. And so that you maintain within your risk budget that's been allowed.
Of course. Thank you, Josee. Ami, I don't know if you have any hedge fund activity on your side. Do you?
Yes, quite a bit. So it's roughly 8 to 10% of the overall fund. We've been very active in investing directly in public market fund managers, really since 2006. And what we seek to do is to generate alpha. We don't really use it in terms of knowledge or trying to assist internal programs. I think in the earlier stages we did in areas like engagement strategies or what's known as activism in the public markets. But we have a lot of separation between our internal teams and what we do with fund managers. Similarly, as Mario mentioned, we seek transparency, attractive terms. We're very long-term focused. We seek repeatability of process. So it's a fairly long-standing and rigorous approach in terms of what we do in hedge fund managers. I would also just add we do early stage managers. It's been in innovation since 2016, and then we have also been doing co-investments in public markets with those managers.
Oh, we'll speak about co-investment. Thank you very much, Amy, but I will stay with you for the other question. I would like to hear about the challenges that you have met in 2020 and the COVID crisis. That was, to say the least, a bit unexpected. It was very severe and created a lot of challenges. So there are maybe different type of dimensions that we can discuss here, but when using external managers in your external manager program, I can think about a few important dimensions. In particular, did the strategies you had deliver what was on the team? Can you tell us about the risk management that you had in such a volatile period? What type of additional due diligence you had to do or not? Did you get the transparency you were expecting from these external managers?
Sure, Eric. Great questions, and I look forward to hearing the other panelists' responses as well. If I may, I'll just start kind of at the firm level, where clearly we didn't anticipate the pandemic, but over many years had been fortifying our risk management approach through greater integration of risks across the fund, through financial crisis planning. Just given we've been in a very long bull market, we had been putting those pieces in place, and that helped us to create a pandemic response. So I'd say internally, our priorities at a firm level had been on ensuring adequate liquidity across the portfolio, as well as supporting our portfolio companies and doing the analysis that had to be done for direct assets that we owned. We did continue to make investments during the height of the crisis in a judicious type of way that ensured liquidity. And then maybe just coming to your questions specifically on our hedge fund exposure, I would say it was very mixed. I mean, we had a very severe deleveraging that created effectively a domino effect, starting with quant strategies, which created forced deleveraging, which then impacted event-driven strategies and fundamental equity. There were bright spots in terms of some of our macro exposures. But I would say I'd share one anecdote that I heard from one of the banks during the kind of March, April timeframe. It was the most orderly type of crisis that people have seen in, I think, perhaps their whole entire careers. I think that there was a lot of transparency, dialogue. There wasn't the type of 08 type of behavior, perhaps, that some allocators had experienced, such as gating and shutting off transparency and communication. I'd say it was very, very measured, and clearly we saw a pretty quick and proactive response on the part of the US Fed, which brought in a lot of stimulus, which helped the recovery pretty early on. So I wouldn't say it was a very quick snapback, but we started to see some traces of return to normal markets, May, June, and it continued to kind of get better and better throughout the summer. But I'd say the strategies that were the quickest to fall were kind of the quickest to snap back again, and ultimately were the best performers in 2020, which was a very strong alpha year for our program. The return of volatility, even though there was very sharp downside risk that we observed, or downside type of performance that we observed in March, April, it ended up being a very strong year actually for hedge fund performance.
Thank you, Amy. Josee, I would like to hear from you on that, because of course the private markets, I mean, they don't have the same volatility that the public market, of course, but how did you manage this type of risk scenario in your allocation?
Well, I certainly echo a lot of what Amy has said, and I'll try not to repeat that and touch on maybe some different points. But she did mention the behavior being very different than the global financial crisis, and that's something that we talked about as well. But that being said, you go in preparing for, again, you always never know when this is happening. One thing you do on the private side is, because there's such a prevalent use of subscription lines to fund initially the investments, you have to kind of know what that's like when you have a large allocation, because you realize that if the behavior was to be a little bit like 08, you could find yourself having to fund all of that within 10 business days, right? So you want to make sure that you're solvent and liquid enough to do so. In our case, that number was in the teens. And so we knew that at any given moment, I mean, the likelihood of all your GPs calling that subscription line at the same time is probably unlikely, but you want to know what that magnitude looks like. So we knew that there was a large amount that could come to us, and you prepare for that. But that wasn't the case. And if anything, we were actually working with them, and we closed quite a few co-invests in Q2 of 2020, because there was a scarcity of capital initially, even though it was short-lived. That liquidity crisis was quite deep initially before things loosened with the Fed action. And some industries were in more disarray. Like we did aviation leasing, for instance, with the airline really, kind of unknowing where it was going to be going forward. The thing on COVID, though, when you ask, what we learned or what changed, and I think we had to present to our committee, because initially when this happened, a lot of the work that you do, and Mario spoke to this, we do a lot of the work, qualitative, quantitative, before investing and so on. You have a pipeline. And so we were able to close on new GPs or transactions that we had been researching for some time. But as the months went by, it was inevitable that we would have to pursue perhaps a general partner that we've never met in person. We've never been in their office. And how would we deal with that? And I would have to say that it's not all negative. The virtual world, there's certainly things that are missing, right? Going to an AGM and talking to your peers in a more informal setting and being able to share, you lose that nuance. However, the logistics of planning that visit and who will be there, and inevitably there's somebody missing at the table because of travel schedules. Well, when you schedule a call, doesn't matter where they are in the world, the head of risk and compliance and anybody you want to meet can jump on that call, and you get to meet everyone. We are a small team, so we tend to divide and conquer. Here, we can get 5 people on a call and share perspectives after to say, okay, that's not how I heard it, but interesting that you picked that up, and as opposed to being maybe a smaller group doing that due diligence on the road. So I think there's been some positives and along with the negatives, obviously. But I would say, this crisis was not like the global financial crisis by any means.
No, and the behavior, it has been noticed in several times in this panel, and I can concur on that as well. Probably it was because the crisis was so unexpected and everyone had to face the same problem in the same terms, that maybe created a bit of solidarity and transparency across the members. Mario, I would like to hear you about your liquidity situation. Were you at that time a liquidity provider and trying to benefit from the crisis with ability to invest, like Amy, for instance, suggested that she has done during the crisis? Were you in this situation where your long-term horizon allows you to be liquidity provider in crisis time? And my second question would be whether this crisis has changed something in the way you manage your external manager program.
I'll start with the second one, echoing a lot of what my colleagues had just mentioned. I think that I would say, to add something different, I would say where we probably saw a little more complexity is to run a thorough operational due diligence, where we like to be on site and kick the tires, if you like. So this is something that has been a little more difficult. So we had to rely, especially for the new managers, and we were, interestingly enough, like my colleagues here, we weren't slowed down by the prospects that we had in mind. We invested pretty much on time with all of them. So we were providing liquidity in areas where we felt there were interesting opportunities. So Ops DD for us for new funds. So we relied on other investors. We relied on a few consultants, people that knew these investment management team. And we had to really bring it down to our risk management committee as to if they were okay and comfortable in for us to use that process of not going on site and kind of closing the loop on the full due diligence. For us, operational due diligence for us has become over the last 20 years one of the most important risks, a risk that you're not compensated for. So you tend to do this type of work more rigorously, I would say. The other thing,
just to rebound on this, Mario, sorry to interrupt you. Just to rebound on this, how do you do your ODD in a virtual way? Is that actually bringing more information to you on how the external manager is functioning, or is that an opportunity for them to hide things or not to share all the information? I mean,
well, it brings a lot of the, the files and the documents. We have plenty, to consult. But I would say, there's always sort of that physical presence going into the office. Where are the servers? What are the different, policies, and which building are you in? What is the security in that building? I mean, this is more difficult, I would say, to evaluate and assess. So clearly, this is where you need to rely on people that have been in those places. And one thing with our peers is that some of them that were invested in the same fund were gracious enough to provide us with information to their knowledge, because they had been invested for several years. So the other thing I wanted to add also is, clearly for us, this way of functioning actually made us develop more business, if you like. We had more access to CIOs and the main risk takers of a firm, much more, I would say, than when we travel on site and you're allowed 25 or 30 minutes with the head or the founder of the company. This format allowed us to have more access to everyone. We use transparency for most of the funds we invested, so managed accounts. So that was pretty much the same. And we were very happy to see that things kind of behaved the way they were supposed to behave. Like Amy, it was a strong alpha year, lots of dispersion. Clearly, the month of March was difficult, but for the rest of the year, especially when September started to happen with lots of rotation, and dispersions amongst styles, sectors, assets, and everything, we started to see very good value add for our programs.
Thank you, Mario. And to the question whether you were offering liquidity to market and being able to be contrarian in this crisis, was the volatility so high that it was quite difficult to do? Or?
Well, the thing is, when this happens, like it happened in mid-March, you're always kind of taking a bit of time to see where the marks, making sure that you always kind of plan for these liquidities, especially. I mean, from a Canadian pension plan point of view in 2008, and where we sat in that period, I think we learned a lot from that lesson, and we had planned for liquidity in a much different way. But it didn't take a long time for us to be more proactive in terms of investing. As things started to stabilize a little bit in early April, May, we were able to bounce back and ready to put into play these strategies that we've been contemplated.
Thank you, Mario. In the next step, I would like to look at the future of how you can look in the future, the external partnership program that you do have. In general, I mean, from an asset manager position, what we've seen is a lot of fees compression over the past year, and I can hear a lot of them saying how far this can go without altering the service offered. How would you look at the evolution of your external partnership program? In that sense, do venture capital or seeding program is a good solution? Direct co-investment when we speak about private market. Amy, you mentioned co-investment. Can you tell us more about what you see here in terms of the structure of your partnership going forward?
Sure. So the group that I'm part of, External Portfolio Management, works with managers in the public market space. We also have a team internally that invests in private equity funds, venture capital, and private equity secondaries. So I can speak to both. I would say our private markets side had been more of a, I guess, first mover in co-investments. I think historically it was more traditional to see that in private equity as a follow-on to deals at zero fees and zero carry. I think the public markets have adopted the idea, and it's grown steadily year after year. What we seek to do in public markets is to try to generate returns from single ideas, whether it's in equities or macro, where there's some kind of unique insight as well as scalability. And we typically will do a kind of 0% management fee and seek some type of performance reward for the manager. We've increasingly been able to work with both existing partners as well as off-platform managers, so those we're not currently invested with. And we see public market co-investments as an opportunity to be agile for us to deploy capital into areas that are either experiencing dislocation or some type of interest. And we've created, I would say, like a portfolio of these ideas. The other feature of it is to average costs down in terms of fees. I think we can all agree that fund investing is expensive, whether public or private. And we try to, Eric, you mentioned the topic of fees earlier. We're not trying to pay the lowest rack rate fees. We want to pay for alpha, and we want to be as aligned as possible. So we've increasingly used our size and presence in the market to try to be leaders in terms of negotiating appropriate structures that whereby the manager can sustain their business and pay and compensate at the kind of fixed cost basis, but also reap the rewards of positive performance above what you get from market beta. So we've really been leaning into that over the years, and that's been effective. Emerging managers is another way of us being able to do that. So it's a kind of offset of the early stage risk that we're taking, whether it be seeding or capital acceleration.
So very interesting point, Amy. I mean, this shift to performance fee, so maybe compress the fixed fees, but and moving to performance fees, is that something, Josee, that you're also seeing with your external managers, or what do you aim doing with your external managers?
Yeah, I think I'm speaking correctly when I say it's probably more prevalent among Canadian investors. A lot of our peers would aim to set up a performance-based fee versus an asset-based fee schedule. We've been doing that for quite a while, and I know of other plans I'm in Ottawa that are doing that as well in that region. It's really a preference of being okay to pay on the upside, but making sure that we're not paying just a base fee when things are not going as well. And so I would say that that's definitely in there. The fees, you're right that they have been coming down, particularly on the public side of things. And I think it's that there are so many passive options now. We can do in-house through derivatives or other products. We can obtain beta fairly cheaply. So it makes it hard. If we're going to pay for something, there has to be a value added to that beta. On the private side, I would say that it's not just in the fee structure that there's been some pressures, but the terms have probably gotten in favor of the limited partner to a certain extent, not on all partnerships. Certainly there are some that are very reputable and large, and they can command the terms that they want to command. But we've seen some movement where perhaps European style distributions instead of American style. We've seen even the ratchet, which is often on the VC side. We're seeing that a little bit on the even a buyout fund. I've seen one where it starts off with a lower a performance fee if it's a lower multiple, and as the multiple gets higher, then you pay more for performance, which is aligned with the investor. And that's the other part, is the alignment. I think in a lot of the investments we go into, that's a very key thing, to make sure that the GP or the manager is aligned. You see it a little less on the conventional side. If it's a product from a firm, they may not have their own livelihood going in there, but you'll see it on the hedge fund side and the alternative side a little bit more, and that's always useful. We can't issue very large tickets like some of our peers, so we don't get the large ticket discounts as much, but we are moving towards that a little bit. I mentioned we're increasing our allocation, and one of the things we're devoted to is not to increase the number of GPs. So we're going to start writing larger tickets. So these are higher conviction plays, and try to continue with the same GP. And that also helps in building that relationship and having better economics, because we are getting a lot of co-invest opportunities from those partners that we stay on for their Fund 2, Fund 3, Fund 4, and so on.
Thank you very much, Josee, for your answer. Mario, size is important, so we know that in negotiation, but also size allows you to inboard potentially new talent, to inboard new expertise. So, is it the case, for instance, that you may consider at some point that there is an asset manager that is doing well, but maybe you're paying too much for that, and you want to inboard the expertise, or you take participation into the hedge fund capital?
I would say that, at the root of the Canadian model is the obviously strong governance, but also how do you internalize some strategies. And you're usually doing this because, first of all, you have the governance to back it up, but also to better manage the costs. So we've done that quite a bit over the last 10 years, I would say, mostly in private markets, again, at the root of the Canadian model. So we've done that. We also, what we've done also is, because of our size, because of our long-term kind of focus, we've been able to, build these platform with investment management companies where we can share some of the economics, but also being able to originate, source, getting the flexibility to invest faster. So we've done that in various parts, from the infra debt to infrastructure in the US. We've been very active to that. So it's not investing into a fund. We call it more of a partner, I would say, versus being invested into a fund, where we're more equal, I would say, where we share more of the good and the bad returns, therefore creating more of an alignment of interest. So we've done that. And taking stakes into funds, we could do it. We could do it, although we're not really looking deliberately to do that. I mean, this is something that I believe probably requires a different skill. I mean, there's probably other ways for us to extract what we want to extract from a relationship with a manager. So,
of course, thank you. It makes sense. Thank you very much, Mario. We're approaching the end of our session, but I would like to take a few more time on the spectacular progression of ESG investing. This is a broad subject. There are many possible angles to this question. We could spend the whole session and just scratch the surface of this topic. But I would like to discuss briefly on diversity first. And one aspect of diversity is gender diversity. And in Europe, I would quote Isabel Schnabel, executive member of the ECB Governing Council, that recently made a lot of comments in a speech on the difficulties that women have still facing in Europe to reach top position. But I understand that Canada is different, and Canada was able to celebrate that 100% of the companies of the S&P TSX Composite Index are having at least a woman on their board this year. I would like to discuss that and what your firms are actually doing to address diversity and ESG in general. And maybe I can ask Josee if you're happy to comment that first.
Sure, and I would love to say that Canada is on the forefront, but being a 120-year-old company, I have to say that our first women president came on after 117 years. So it took a long time to get one. And we have our first woman CEO as of last September. So it's a long time coming. We are very focused on D&I, the diversity and inclusion, to the point where it's become a strategic objective. My peers and I are going on a training, a 6-month training on this to identify whether there are biases that we subconsciously or not. It'll be the Canadian Coalition for Diversity and Inclusion that gives this training. And last week at our board, we had a whole session on psychological safety, which is to say that people need to feel comfortable saying what they have to say. And that's the I part, the inclusion. So I think the diversity, it's not diversity of gender and visible minorities, it's diversity of thought. We really want to encourage different perspective, diverse points of view, and include everyone in the conversation. And so there's a lot of effort actually going on from the board level down on this initiative. And we also are looking to see how we can make that a formal part of our process with our external partners on the investment side.
And in your investment policy, are you doing something? Are you making some choices? Are you having a process that give a bit of an ESG angle to your investment policy?
So far, it's been all informal. So for years now, we have addressed those issues with our managers during the due diligence process and during the oversight. But as I mentioned, so it's becoming more on the forefront. So 2022, we actually have it as a strategic objective of the CMPA, where we will develop and formalize what that will look like.
Thank you, Josee. Amy, I mean, did you have a similar experience with Canadian Pension Plan?
Yes, so we, like most organizations, are really treating inclusion and diversity with utmost importance. We have been focused on it quite a bit internally. We have at our board level a very gender balanced board, same for our senior leadership team, and we've done the analysis kind of across the employee base of the firm. Clearly have work to do in terms of certain areas, but very focused on that. We also brought on a director of inclusion and diversity several years ago who's helping us think through the biasing pieces that Josee mentioned. And then in terms of externally, for many years, we've been focused on engaging at the board effectiveness level. So thinking about transparency, having the right skills on boards, and that could extend to gender, but I agree with Josee, it can be something more broad as well. But we really try to assert ourselves in terms of things like the 30% club, or just having the gender piece taken into consideration, both in Canada and in Asia, and I think we will be continuing to work on that. We also have gender diversity voting practices in terms of, as I just mentioned, representation on boards. So our goal is to improve gender balance, but I do agree with Josee. We can see diversity in many different dimensions, socioeconomic and other areas as well. Age is kind of increasingly one too that I think corporates are taking into account. So I think it's a really big and important topic that will continue to be on our agenda.
Thank you very much, Amy. Mario, I would like to finish with you, and of course, internal policy at Caisse de Dépôt, but also if your investment process is changing right now with all this initiative on decarbonization of investments, with the US coming back to the Paris Agreement, and a lot of things happening in Europe in terms of EU taxonomy. Does that impact your investment policy at this stage?
Yeah, we adopted in 2017 a policy to reduce our carbon footprint by 25% in 2025, and at in the same token, investing in more carbon neutral assets in absolute dollars. So so this is something that has been prevalent for several years now. The pillars here essentially are we factor in climate change in every investment decisions that we take. It's not only the expected return or the risk, but now it's the carbon footprint as well. So we measure this, this actually has taken very good momentum across the investment teams. We were, to be honest with you, always a bit doubtful at start because we were expecting to only be able to invest in not necessarily the best projects or the best assets, but what we're finding now is that we're finding quite a bit of opportunities in that sector. I'd like to add that in order for sort of the behavior to change, we did something that I think was really important, is that we linked the carbon footprint targets with variable compensation. So every investment team has a target per year, and clearly, if you're not following your targets, which are very conservative targets, I mean, it's not an aggressive target; it's just a very step function targets that will lead us to 2025. You're being penalized on your variable compensation. So in finance, people say. Tell me how people are paid, and I'll tell you about their behavior. This is one thing that we've done. I think that has paid lots of dividends, and now nobody talks about finding it difficult to find good investment opportunities from infrastructure, real estate, private markets, private debt. Public markets obviously is easier in some ways because of the liquidity, but it's been a very good project for us so far.
Thank you very much, Mario, to have shared this information. I think it's now time to close our session today, and I would like to thank iConnections for organizing this panel, but also, and almost foremost, to thank you very much for your participation, Josee Mondoux from Canada Medical Protection Association, Amy Flikerski from Canada Pension Plan Investment Board, and Mario Therrien from Caisse de dépôt and Placement du Québec. Thank you very much for your engagement today in this panel. Goodbye.